In simplest terms, an interest rate is the cost of borrowing money. Think of it as a rental fee for using someone else's funds. This someone else is often a bank or financial institution. Borrowers pay interest, while lenders earn interest. Conversely, interest rates can also refer to the reward for saving money. When you deposit money in a savings account, the bank pays you interest for the privilege of using your funds. Essentially, you are the lender in this scenario. Interest rates are expressed as a percentage. This percentage represents the proportion of the loan or deposit that will be charged or earned as interest over a specific period, typically a year. Understanding interest rates is crucial for managing your personal finances effectively. Banks determine interest rates based on a variety of factors. One key factor is the federal funds rate, which is the interest rate that banks charge each other for overnight loans. The Federal Reserve, the central bank of the United States, sets the federal funds rate. Other factors influencing interest rates include inflation, economic growth, and the supply and demand for credit. When the economy is strong and inflation is high, interest rates tend to rise. Conversely, when the economy weakens and inflation cools, interest rates generally decline. For loans, the interest rate you receive will also depend on your creditworthiness. Borrowers with good credit scores typically qualify for lower interest rates, signifying lower risk for the lender. Those with poor credit scores may face higher interest rates, reflecting a greater likelihood of default. High interest rates make borrowing more expensive. For example, a high interest rate on a mortgage translates into larger monthly payments. Similarly, high interest rates on credit cards mean you'll accrue more debt if you carry a balance. On the flip side, high interest rates can be beneficial for savers. A high interest rate on a savings account allows your money to grow faster. Certificates of deposit, or CDs, also tend to offer higher interest rates when overall rates are high. The downside of high interest rates for the broader economy is that they can slow economic growth. Businesses may be less inclined to borrow and invest when interest rates are high, potentially leading to reduced hiring and economic activity. Section 4. The impact of low interest rates. Low interest rates make borrowing more affordable. A low interest rate on a mortgage can save you thousands of dollars over the life of the loan. Credit card debt is also less burdensome when interest rates are low, although it's always best to pay your balance in full each month. However, low interest rates mean savers earn less on their deposits. Savings accounts and CDs may yield meager returns when interest rates are low, making it more challenging to grow your savings. For the economy as a whole, low interest rates can stimulate economic growth. Businesses may be more likely to borrow and invest when interest rates are low, potentially leading to job creation and increased consumer spending. Section 5. Navigating the interest rate landscape. Interest rates are constantly fluctuating, influenced by a multitude of factors. Understanding how interest rates work and their impact on your finances is crucial for making informed financial decisions. When interest rates are high, prioritize paying down high-interest debt and consider saving more aggressively. When interest rates are low, it might be a good time to refinance your mortgage or take advantage of lower interest rates on loans for major purchases. Remember, managing your personal finances effectively requires staying informed about interest rate trends and adapting your financial strategies accordingly.